All right, do you want to give the audience a quick introduction to yourself? And thank you guys for doing this. I know it's really late on your side, almost 6 p.m. So I really appreciate it.
Yeah, of course. Happy to speak with everyone. My name is Jamie Chapman. As Ellen mentioned, I'm a lead product manager at Gemini. I work on a lot of our customer-facing products. So a lot of what you see on the mobile app or our exchange is what I've worked on. I'm currently on the team for Gemini Earn, which is our yield generating product, and Gemini Green, which is our climate awareness program.
Awesome.
Yep, and I'm Jake Schlessinger. I'm a product manager on the wallet side here at Gemini. I've been here 3 years and I've had a few different roles, but most recently working on wallet products here.
Awesome. Welcome, guys. So I'm going to let you take over the screen share and then start your presentation.
Awesome. Okay. Welcome, everyone. Thanks again for coming. We are really excited to speak with you to talk a little bit more about crypto, how it's used, and answer any of the questions you may have. So this is our agenda for today. We'll go over why is crypto important? What are the building blocks of crypto? What's the foundational layer for this whole financial ecosystem? How you can get involved in buying, selling, whatever crypto you'd like to do. We'll talk a little bit about Ethereum and ERC-20 tokens. We'll talk about what crypto is like today and also what some potential future applications of crypto look like. And then we'll leave plenty of time at the end for a Q&A. So throughout this presentation, please feel free to drop your questions in the little Q&A box on your screen. Okay, we'll start first with why is this important? Over the past couple of months, I mean, if you paid attention to the news, crypto has, experienced this kind of valleys and hills of media coverage. It typically correlates with price, or if some recognizable person purchases a lot of crypto, but it is undeniably becoming more of the mainstream conversation. So we'll get into this a little bit. First, let's go over what it means to be a deflationary currency versus an inflationary currency. So we'll start with something we're all familiar with, which is inflationary currencies like the US dollar. Any currency issued by a government, that's called a fiat currency. So this is cash. Fiat currencies are printed by a government. Therefore, the value of a fiat currency decreases over time because it becomes less rare. Well, it's because central banks print more money, therefore making it less rare. So there's just more of the thing in circulation, meaning each one individual thing loses a little bit of value. I think target inflation rate right now, well, historically it's been around 2% for the US dollar, but I think it's a little bit higher right now. On the flip side is deflationary currencies, and this means that a currency that actually increases in value over time. And so you can achieve that by either limiting the supply of the currency as it's created, or capping the supply of total units ever created. So Bitcoin is a deflationary currency. Bitcoin has a supply cap of 21 million Bitcoin. Only 21 million Bitcoin will ever be created. That's baked into the source code. Nobody can change this. I think that, and Jake, maybe you can correct me if I'm wrong, the 21 millionth Bitcoin is set to be created sometime in the next century. So it'll be past our lifetimes. This makes it scarce and deflationary in nature. So in theory, the value of a Bitcoin will continue to increase because it becomes more scarce. Okay, so let's dive into what Bitcoin is. Bitcoin is money. Let's pause here and think about what money is. So money has 3 characteristics. Money is a unit of account, it is a store of value, and it is a medium of exchange. And we don't really think about this as we use dollars every day, but I'm confident with the US dollar that that a US dollar will fulfill those three properties of money. I am confident in that. It is a currency, so you can transact, and I can pay Jake with Bitcoin. Jake can compensate me for some job I did in Bitcoin. And yeah, so that's a lot. It has a lot of the characteristics of US dollar, with, I think the major exception is that there is some volatility right now, whereas the value of $1 is very stable. So unlike the money that we're used to, like dollars, a Bitcoin is actually stored on the internet. So it's an internet native currency, which makes it available for the entire world to use. If you have an internet connection, you can use Bitcoin. Sorry. So, okay, there's little two details to get out of the way. You'll see uppercase Bitcoin and lowercase b Bitcoin. So lowercase b Bitcoin is the currency. And just like we mentioned, it is stored on the internet. It is global. It's made for the entire world to use regardless of your location. The capital B Bitcoin is the network, like the foundational network that provides the technology for lowercase Bitcoin to work. So uppercase Bitcoin, the network, is this peer-to-peer decentralized network. Peer-to-peer means me to Jake, Jake to Ellen, Ellen to me. And decentralized means that maybe we're all running our own computers and we can talk to whoever we want that's on that network. We don't need like a centralized bank or an intermediary in order to transact with Bitcoin. So it allows users to send units of value, in this case Bitcoin, to each other without anyone in the middle taking cuts or fees.
All right, now I can talk a little bit about like the building blocks and attempt to explain the technology behind Bitcoin. And there can be like a lot of like technical jargon and like buzzwords thrown around when explaining Bitcoin, but I'm going to do my best to try to break it down into a few core principles here. So on the next slide, it shows there's basically like a few core tenets, that one being the fact that it's a global currency. It's digital and it's natively digital, meaning that it like lives on the internet, and it's decentralized, meaning that there's no central authority. It's sort of like a group consensus that allows transactions to flow through. Sorry, Jamie, do you see the slides here? Did we switch slides?
I don't see the slides anymore.
All right, well, I can present my screen. Nope. All right. Okay, let me just click present. Okay, yeah, these are the few core tenets. It's global, digitally native, and decentralized, meaning that anyone can access it using a computer, and there's no centralized counterparty that you need to interact with, just the network itself, which is made up of a multitude of parties. And so there's sort of like a few different, layers here. Bitcoin, like in these concentric circles, Bitcoin is the center here. It's a type of cryptocurrency, Bitcoin being the most popular by value of like total Bitcoins or of total value. There are a few other cryptocurrencies out there like Ethereum that are wildly popular. However, Bitcoin is the most popular. And then there's also, those live within a blockchain. And so a blockchain is sort of like the mechanism on which all this is possible. It's decentralized, and it uses hashing to validate transactions that flow through it. Okay. And so miners are essentially the ones who validate the network here. So miners are the ones who see transactions. Like if I go and try to pay Jamie 1 Bitcoin for some service that she provided, I send it out to the network, and then all of the miners can see this like queue that's called mempool, and they will take transactions from mempool and validate them through a complex mathematical problem called hashing. And while miners are hashing these blocks, they're securing the network, they're building on top of the previous block, and each block is mined around every 10 minutes. And it's a complete, it's completely decentralized. Like if you have a computer, anyone can try to mine Bitcoin at this point. However, there are a lot of miners, a lot of people spending a lot of money on hardware to secure the network here, which goes to show like how valuable the network is. And to incentivize miners to act honestly, miners get all of the fees that are paid on the network as well as a block reward. And every 4 years, the block reward gets cut in half until we reach a total supply of 21 million. And right now, the block reward is at 6.25 Bitcoin per block. When Bitcoin was created in 2009, it was at 50. So there's been a few halvenings since then. It's gone from 50, 25, 12 and a half. Now it's at 6.25 Bitcoin per block. And so this is just a cool graphical representation of how like the supply of Bitcoin gets distributed. And so every 4 years, you can see these little dents in the chart every 4 years where like the curve gets flattened a little bit. And then the theoretical cap of 21 million Bitcoins will be mined around the year 2140. And you can see like the US monetary supply on the right-hand side. And this is just the government, or specifically the US government, the Fed, just printing dollars for, you can see there's a big spike in 2008 with a lot of stimulus going on. And then more recently in 2020, you can see like a huge percentage of dollars ever were printed in the last calendar year. And so proof of work, this is a little bit more detail on the method by which miners validate transactions and secure the network. So this proof of work is essentially you're proving that you're doing the work to validate these transactions. There's basically the way a miner works is they'll take those transactions from mempool and they will basically just run this like hashing mechanism, which they can't predict what the outcome will be, but they're trying to get to a hash that has a certain number of leading zeros. And dependent upon how many miners there are on the network, the number of leading zeros will increase or decrease to target that 10 minutes between transactions. And it's essentially guess and check. So what they're doing by like running these computers all the time to mine Bitcoin is they're one, validating transactions, but two, trying to get to that block hash that has like X number of leading zeros by basically guessing 0, 1, 2, all the way up until a valid solution is found. So speaking more about the halving is, or the halvening, as they call it, is when the block reward is cut in half every 4 years. This is just like the monetary policy of Bitcoin, and the best part about that is that it's widely known and it's in the code of Bitcoin itself. And that's using proof of work. Proof of stake is a different type of consensus mechanism where miners, or like stakers in this case, will be putting up their funds for risk and saying like, hey, I'm putting up these funds, and if I validate this block incorrectly, then you can like take a portion of these funds that I'm risking here. Or if you validate properly and the miners after you say that you have mined properly, then you get the block reward that is baked into the code there. Ethereum, once ETH 2.0 comes out, is going to be moving to proof of stake. Currently, Tezos is one of the larger proof of stake networks around, and Gemini just launched Tezos today, which is pretty cool. Now I'm going to pass it to Jamie to talk about peer-to-peer.
Yeah. So what does peer-to-peer mean? So today we're living in this online world, which means there's no way for us to put cash online without relying on a third party. So if you're using your bank account or your credit card or Venmo or Cash App, all these like very popular financial apps that are kind of baked into our everyday life now, there's no pile of dollar bills sitting somewhere in a vault for each dollar in your account. Like there's no, Venmo isn't keeping a separate little address for Jamie saying this is all of Jamie's money. Instead, they just keep a record of how much money is in everyone's Venmo account. This is called they use an omnibus account. So they pull all of their money. And then really what they do is just keep track of whose is whose. And so these are called ledger entries. So when I pay Jake $10 on Venmo, they just change their records. Like the money doesn't actually move. So Venmo or your bank or the government, they do have some sort of oversight or control over these funds. There of course is the risk that they can mess up these records and ledger transfers. Any regulated bank or financial service app has very strict regulation and audit. So it doesn't happen very often, but it is possible. So this works well in the US. As I mentioned before, I trust my bank. I trust the value of the US dollar as a form of money. And we have extremely stringent consumer protection laws and regulations that all banks are required to comply with. However, there are a lot of places in the world where banks are not as trustworthy as the US bank. So I think there was an instance in Cyprus in 2013. Customers lost a lot of their funds as tax taken by the bank. And that's kind of nerve-wracking, I would say, if I was, getting my paycheck in a currency that I wasn't sure would be around tomorrow. That's kind of freaky. So, and you can't opt out of that system. If the US financial system were really, really bad, but we live in the US, that's kind of like tough luck for us. So before crypto, there was no way to pay for something online without having a financial institution handle it for you. And when these financial institutions handle these transfers for you, there are a ton of people and services between myself and Jake, like I mentioned earlier, taking fees for their services along this route. So crypto is a way to just kind of cut all that out and execute a peer-to-peer transfer that can transcend borders. Sorry. So I'm just lost. Here we go. So Bitcoin solves this problem in two ways. First, every Bitcoin account, we'll call it an address. It has this 160 character random looking password. So we call it a private key. And the person who has the password is the person who owns the Bitcoin. And they're the only person who can access that Bitcoin. You need that password in order to send Bitcoin to someone else or to spend it. So if you don't have that password, you can't spend it or take away that Bitcoin. And that's one option for how to store it. And we'll get into this a little bit later. There's a downside with this is that, being your own bank comes with the risk. If you lose that password, you're kind of out of luck. So the records of all these Bitcoin transactions and address balances, instead of being held at a private company like Venmo, they're out there. They're out there on the internet and they're independently verifiable. So everyone can see it. If someone has my wallet address, it's what we call pseudonymous. So it's the funds in the address are publicly available, but it would be very difficult if I didn't tell somebody for them to trace that address back to me. So yeah, if someone knows your address, they can see how many Bitcoins you have, but only if they know their address. And this is how you would transact with someone without a third party. So this is why Bitcoin is referred to as digital cash. Okay, in summary, Bitcoin is the global money built for the internet. It is borderless. Anyone can use it. Anyone can send it to anybody else. You can keep it or it's stored in addresses, which is kind of like an account. And the way to address that or access that address is by using a private key, which we can think of as a password. Okay, so now we've learned a bit more about the details of Bitcoin, why it's cool, why it offers some benefits, or just why it's different from US dollars. So how can you as an individual get involved with Bitcoin?
Jamie, I think we might have lost Jake. I think his Wi-Fi connection might have failed.
Okay, yeah, we're having some Wi-Fi issues.
Yeah, do you want to bring up your slides if you need to talk?
Sure, yeah, I can. Well, the tough part is he needs to do the next slide. I can take over.
I can stop the screen share for him. Let's see.
Okay, let me start to present. This might take a minute.
No, it looks good. It's coming up on my side.
It is?
Yes. Hey, Jake, welcome back.
Out for a second.
Don't worry.
Oh, Jake, is that you?
Yes.
Okay, great. Okay, cool. We're on slide 19, after how to get involved. Awesome. So yeah, Jake, you can
I could take the slide from here. Yep. Thanks, Jamie. So a cool part about Bitcoin is that it's like divisible. You don't have to buy like an entire Bitcoin, which is like a common misconception in the space. So the smallest divisible amount of one Bitcoin is called a Satoshi. A Satoshi is like 1 × 10⁸ Bitcoin. And that's like the smallest unit of account within like the Bitcoin network. And on most exchanges, Gemini included, you can buy small amounts of Bitcoin. You don't have to buy like an entire Bitcoin. That would be like pretty limiting. But you can buy as little as $5 worth on Gemini. And yeah, they're called Satoshis because they the founder of named after the founder of Bitcoin, which is Satoshi Nakamoto. And so moving on, how to get Bitcoin. Obviously, like one way is to buy it. Gemini is an exchange. That's our business. People buy and sell Bitcoin and other cryptocurrencies on our exchange every day. There are also Bitcoin ATMs. A Bitcoin ATM will likely charge you higher fees, but they can take cash, which is pretty cool. So like, if you see one at a gas station, you could just put in some cash and they'll print out, a private key for you that has like the proper amount of Bitcoin on that wallet. Or maybe you can like send it to like another wallet that you set up. Or you can, get it from other people who just gift it to you. You can also earn it, which includes, getting paid for services in Bitcoin or Bitcoin mining, which is, a pretty saturated space at this point. It's hard to get involved in Bitcoin mining without like millions of dollars of mining equipment at this point. But a lot of people do it, and it's a common way to get Bitcoin. Now I'm going to hand it back to Jamie to talk about the price and the volatility.
Yeah, and this is a pretty hot topic. So how is the Bitcoin price the price of Bitcoin, and why does it change so much? And really the answer is that Bitcoin is very early, and it is very cool because it is kind of a very pure market experiment, I would say. The price is set purely by supply and demand. So, just like other markets, like the stock market or a foreign exchange market, or like goods at the supermarket or gas at the pump, it is determined by supply and demand. If more people want to buy Bitcoin than want to sell it, then the price goes up, and vice versa. If more people are trying to, if more people are trying to get rid of Bitcoin, the price will go down. So when you look at a Bitcoin price, you're really looking at the last price someone was willing to pay to buy a Bitcoin. So if someone just bought 1/10 of a Bitcoin for $3,000, that means that one Bitcoin at that exchange is worth $30,000. So exchanges like Gemini are constantly matching up buyers and sellers. This is the core of any exchange's business, is a matching engine. And so they match these two parties at a price that they can both agree on. And this is automatic, in the background to us. It looks like a very slick UI. I just see what the price of Bitcoin is and I can purchase it. But that means that someone is willing to sell some amount of Bitcoin at that price to me. So exchanges are a really good place to learn the price of Bitcoin or other cryptocurrencies.
So this is a common question that I get a lot. Why should I get into Bitcoin? Yeah, I mean, like the first use case here is like using it as a currency. There's more and more like vendors that are starting to accept Bitcoin as a medium of exchange. Tesla famously accepted, then reneged, and now announced today that they are holding Bitcoin still. But there are plenty of merchants out there that accept Bitcoin and other cryptocurrencies as a payment method, which is pretty awesome and fairly new. Like a few years ago, you could really only spend your Bitcoin on like a select number of things. And also it's a way to sort of hedge against your own currency. In the US, we don't really think about this too much because the US dollar is like a global reserve currency. But if you're living in, a country that doesn't really have a stable central bank, that's not pegged, and the fiat currency is not really pegged to anything, and if the Fed in that country loses control, they can print a lot of money and end up like a situation like Zimbabwe had a few years ago, where like $1 trillion in Zimbabwe dollars was worth a few pennies in US dollars. Another way you can get involved is just by like buying and holding, or like just investing in it. A lot of money managers and institutions are getting involved in crypto as a sort of like hedge against things like inflation, or a hedge against traditional equities. It's just a very uncorrelated asset, which is pretty desirable in a diverse portfolio. And there are a lot of people that just play the markets, buy when it's low and sell when it's high. It's super volatile. So there are plenty of people that, that do that every day on our exchange.
Okay, back to how to keep your Bitcoin safe. So there's really two options here. You can store it yourself, or you can use an online service to store it. So wherever it's stored, for both of these options, ultimately your Bitcoin is called, the place that you store your Bitcoin is called a wallet. So that can be a physical device or a phone app or an online service. So storing it yourself would require you to download a phone or computer app, or maybe even a special device that connects using USB or Bluetooth. This would, remember that when we talked about needing a special password to spend Bitcoin out of an address. So if you're storing Bitcoin yourself, you and only you have access to that password for your address. That means you're completely in control of what happens with your Bitcoins. Nobody else can access it. But if you lose that password, you've lost your money. It's gone. So this is be your own bank theory. You have to protect your private key. The other option is to use an online service like Gemini or another exchange to store your Bitcoin for you. And so to me as a customer, this just looks like I have an online account somewhere and I'm looking at my account balance. That is Gemini storing my crypto for me. It ends up looking and feeling a lot more like an online bank account. Like this, looking at my balance on Gemini is no different than looking at my balance on my Chase bank app. I personally would tend to recommend this option, especially if you're just getting into crypto. I can tell you here at Gemini, we've invested millions of dollars to build institutional grade security to design our like crypto security system. So I would personally trust that any day over a device in my desk drawer or making sure I can remember some private key.
Yep. So now I'm going to be talking a little bit more about Ethereum, which is, like I mentioned earlier, the second largest public blockchain by market cap, and ERC-20 tokens, which are tokens that use the security of the Ethereum network, but have like different tokens for a whole variety of different use cases on top of the network. So the main difference between Bitcoin and Ethereum, like on the next slide, is basically Bitcoin is primarily used to support like the single application being like the Bitcoin network. There are instructions that you can build to on the Bitcoin network to sort of create like pseudo smart contracts. However, it's a lot more difficult than using Ethereum, which has a native language called Solidity built on top of it to build like these decentralized applications or dApps that anyone can plug in with. They have a lot of great like software that's been built by a lot of like the Ethereum Foundation companies that make it super easy to both develop and interact as a user on Ethereum. Bitcoin also has a block time that confirms every 10 minutes, as I mentioned earlier. Ethereum is much quicker. It has, and basically it's every 15 seconds, which is like lightning fast compared to Bitcoin. And then another major difference here is that Bitcoin has that supply cap of 21 million that we've mentioned before. However, Ethereum, the native asset Ether, does not have a supply cap. It's currently issued around like 4.5% per year. However, there's an EIP, like Ethereum Improvement Proposal, that should be going live next month that will lower that and burn many of the fees that go to miners, which is pretty cool to see that Ethereum is like innovating in that way. So a little bit more about Ethereum. It was built by Vitalik Buterin in 2014. They built this programming language on top of it to make it super easy for developers, developers new to crypto, to build applications on top of Ethereum. You may have heard of like the ICO boom in 2017. All of those tokens were basically built on the Ethereum network, where people would deposit Ether in, so you can get like a pre-sale of like these tokens. And then, once the sale filled, you'd get your ERC-20 tokens out. All of that is sort of facilitated by what we call smart contracts. And a smart contract can be, basically any code that's run on the Ethereum network. It can be as simple as like a time-locked function where it's like, hey, I want to pay Jamie 5 Ether, but don't do it until, 30 days has passed. And so I'll send the 5 Ether into that smart contract. And then once the blockchain, like it doesn't know time, but it'll, you estimate in like the number of blocks. But once like those certain number of blocks has passed, it will transfer those assets to Jamie's wallet. So that's like a very simple example. But another example is an ERC-20 token, which is a token, that can be used, that we'll give examples for in a few slides here. But, basically a token that powers like an individual system that's built on top of Ethereum. And this was a huge step forward at the time, because the main use case for, cryptocurrency was like just Bitcoin itself, which was basically just like digital cash. And so being able to build like, new foundations of money that can be, read and programmed by anyone is pretty powerful. And so, yeah, you're talking more about smart contracts here. Bitcoin primarily used just for, peer-to-peer, cash settlement. Ethereum can do the same thing with Ether or any of its other assets on top of it, like ERC-20 tokens, but there's also programs that that I mentioned earlier. There are a lot of smart contracts out there that can track things like art collectibles, like NFTs, or, building a decentralized VPN, which we'll talk about in a minute. Even things like, data feeds. There's a lot of stuff that you can do with these smart contracts. NFTs, for those of you who don't know, stand for non-fungible tokens. And at a high level, Bitcoin, Ethereum, dollars, these are all fungible assets, which means that, one Bitcoin is like no different from another Bitcoin. Same with, if you're selling something and someone gives you like a $50 bill, you don't care if it's a $50 bill or like, with a specific serial code or like two 20s and a 10. It's all like $50. Non-fungible assets are not, it's sort of like property is a non-fungible asset, or art, where, art, for example, there can be additions of something, but it still has that addition number where it's like 1 of 50 or like 30 of 50. Property is the same way. All properties are unique. But there are assets like that can be built on top of Ethereum. And Gemini actually has an NFT platform called Nifty Gateway, where we do drops at least once a day for new artists and some really popular artists that you've probably heard of selling their NFT artwork on Nifty Gateway. And so a little bit more about smart contracts. Like I mentioned, they're shorthand called dApps. They're the building blocks of decentralized finance. There's a lot of different stuff that's going on in the DeFi world right now. Things like lending protocols, where like I go in and I can, deposit my Ether into a smart contract, and then someone can like go and borrow it from the other side. And, the smart contract will automatically come up with like a rate that based on supply and demand, how much I should be getting paid in interest for lending out my tokens, and how much the borrower should be paying into the network. And the network will typically take fees. But it's much more open than, taking a loan out from a bank. It's like, you don't know what their borrowing rate is, or how much they're paying their customers for the money that you're borrowing all the time. So it's pretty cool to see that it's completely open like that. There are games built on Ethereum, believe it or not. A lot of NFT use cases are built around like collecting specific items for these blockchain games like Axie Infinity or CryptoKitties, things like that, where, even if the game like goes away, right, then you still own the item, and it can still have value. And then, we can track property, collectibles, and art as well. And then on the next slide, I'll go a little bit more into, the assets like DAI, Link, Orchid, and Basic Attention Token. So those are mentioned at the bottom here. These are all utility tokens built on top of Ethereum. But, there are a ton of other cryptocurrencies out there. Like anyone can build, an asset on Ethereum, just the same way that anyone can, fork Bitcoin's code and deploy it themselves. But it's not going to be nearly as like secure. There's not going to be that many miners that are supporting that network. But there's things like Kanye West, right? Like people just like tweak the code of one thing and then launch their own thing. But who knows how popular things like that are going to be. Zcash is like a very well-known privacy coin, which has encrypted transactions, which is pretty cool. Where you can't really tell like who's sending what to who. Only like the miners can. Even the miners don't know. It's uses this technology called ZK snarks. But regardless, the code for that is open source, and so someone can go out there and create Ycash, which is essentially just Zcash, but with they fork the code and not nearly as popular. DAI is like an algorithmic stablecoin. Jamie's going to talk a little bit more about stablecoins later. And then Link, BAT, and OXT, I'll go into a little more in depth on the next slide. So Orchid, a high level overview of Orchid is that it's a decentralized VPN provider. And so what Orchid has done, they've created this OXT token as like the use, like the main like payment system on Orchid, as well as like a token that you need to use to like be a bandwidth provider on the network. So what they do is like the Orchid protocol will use Ethereum, and it will connect people who have like, you know, a bunch of, you know, people who are VPN providers, like maybe they, or you have a bunch of servers in a lot of places, you know, you can set up with Orchid here and, you know, sort of like just allow like the Orchid network to select like their own users to connect to your servers and, you know, basically just use a VPN service here. And the OXT token is the token that facilitates the payment on that network, but it's built on top of Ethereum, because for a protocol like Orchid, it doesn't really make sense for them to build their own blockchain for one specific use case like this. There's probably not going to be a lot of interest from people who want to go mine specifically this Orchid token. So it makes sense for them to like leverage the, you know, the Ethereum network here. And even on top of that, like the whole point of this being on top of Ethereum is that, you know, there are centralized companies that run things like NordVPN or other VPN providers. And so this sort of like bypasses that and allows like anyone with an internet connection to access the Orchid network and like use a decentralized VPN. Chainlink is like a very popular ERC-20 token as well. Link is the native asset to that network, and Chainlink is also built on other blockchains as well, as the name might hint at. But essentially what they're trying to do is provide offline, like off-chain, real-world data to the blockchain. The most common use case is pricing data from exchanges, but it can be literally anything. So if there's a decentralized application where people are, let's say, betting on the outcome of a sports game, Chainlink can, you know, be like a data provider for the, you know, the score at any given time. And so, you know, anyone who can like run this like the Chainlink software and provide data to it in a reasonable way and you know, trusted way, will be able to like say like, okay, like the outcome of the game was like, you know, 5-6, or, you know, Yankees over Red Sox or something. And so there's like tons of use cases for bringing real world data onto a blockchain, but that's just one of them. And then the final one I'm going to talk about here is Basic Attention Token, another token that's built natively on Ethereum. This one is pretty interesting. It's used to connect content creators it's meant to reward content creators directly instead of having, you know, advertisers pay for websites. So Basic Attention Token is essentially created to pay for people for like viewing ads as well. And, you know, it incentivizes a different model than like using digital advertisers dominated by like Google or Facebook that like, you know, take your data. Basically, users can pay small amounts to content creators as well to use like the Brave browser, which is an open source free browser. And it's more privacy focused and crypto native than you know, any other browser experience out there. And users can also be rewarded for viewing ads. So, you know, that's why the name is Basic Attention Token. You get rewarded for viewing ads instead of like having ads be like constantly present. So you can choose to view ads and get paid for it, or not earn anything and not, you know, view ads.
So let's, touch on stablecoins again. So one really interesting thing that ERC-20 tokens have been used for is to create stablecoins. And a stablecoin is a token with the value pegged to a fiat currency, meaning 1 unit of that stablecoin equals, and will always equal 1 unit of that fiat currency, which is cash, as we learned earlier. This can be used in trading to achieve liquidity without, having like on-off ramping fees. But there's also many other use cases for a stablecoin. I mean, really, it combines kind of the best of both worlds, like the speed and security of crypto transactions and the stability and trust of, well, at least in the US dollar case, like of a fiat currency. There are a number of governments who have created or are thinking about creating digital dollars. China and Russia have both announced that they're considering creating digital versions of their currencies. Venezuela has created one, but it hasn't really achieved adoption. And just 2 days ago, the US government said that they are working very quickly to establish a regulatory framework for stablecoins. And I think that from the US perspective, that's really like the hurdle that they want to tackle right now is that regulatory framework. Okay, one last example for how the Ethereum can be used, and this is really cool. Jake, you mentioned non-fungible tokens and fungible tokens earlier. So NFTs, which stands for non-fungible token, also known as NFTs, these are cryptographic tokens that represent a unique asset or a good on the blockchain. So that means that no two NFTs are alike. So what does this really mean? This means that it's unique, it's irreplaceable, and it's non-interchangeable as another crypto would be. So you may have heard there's big news around NFTs a couple months ago. You might have heard of an artist named Equal. He sold the first ever digital work of art at a major auction house. He sold his work every days at Christie's for $68 million. I mean, really, that's a watershed moment in the world of NFTs. But I mean, really, what the purchaser got when they bought that work of art was like code. They were buying code, and they can display it on, like on a monitor in their home. They could never display it if they want, but this is unique. So another really cool thing that applies to content creation, especially in this, like the creator economy, is that right now, let's say like I am a photographer and I take a picture of something and I sell it to somebody. If that person sells that piece of art, like let's say it's hanging on a wall, if they sell that, again, I don't see any of those profits. With NFTs, you can bake whatever you want. Like as an artist, you can bake whatever you want into that code. So I could say like every time that my work of art is sold, I get a 5% cut or whatever. So you continue to see the benefits as your art appreciates, as it like changes hands, things like that. So a lot of promise here. I want to be conscious of the time, so I'm kind of going to breeze through these last questions because I see a couple, or these last slides, so because I see some questions in the Q&A. So crypto today, we can go to the next slide, Emma. I mean, we kind of covered a lot of what people are doing with crypto today. A very common use is investing as a long-term, or holding as a long-term investment, or trading as a short-term speculation. You can use it for fast and direct payments to anybody in the world. You can pay for your coffee. You can pay for goods with crypto. The coffee, groceries, home decor, Gemini actually has a service called Gemini Pay, where you can take your phone to like a brick and mortar store and you can pay for your coffee with crypto. And then you can also use smart contracts like NFTs. Crypto is so young. It is a very nascent space. So this, like the future of crypto is, I mean, it's speculation. We can all kind of brainstorm on where we think the space can go, but let's go into a few possibilities for the future of crypto. Trading is a really, really big part of the crypto ecosystem. A lot of people enter crypto because they want their assets to appreciate. However, currency will very likely go digital like everything else. in that world, there's probably have to be less volatility with crypto, but so that might be a long ways away. Decentralized finance or DeFi is a set of ERC or Ethereum based tokens that aim to pretty much replicate or, mirror traditional finance, just like in this crypto way. You can use smart contracts to replace a lot of the functionality offered by banks that really isn't serving customers well. Yeah, I mean, you can make a lot of money on your savings if you invest well. And it's risky right now. So that's a big asterisk. Smart contracts can replace middlemen in certain transactions. And then there's more practical utilizations like tracking information like the deed to your house, diploma, identity, any real information can be tracked through a smart contract on the blockchain. Okay, we've covered a lot today. So quick summary. Cryptocurrencies are a relatively new form of money with no central authority. There are a lot of different types of cryptocurrencies, but the most famous and the cryptos with the biggest market caps are Bitcoin, which is good for payments, and Ethereum, which, as Jake mentioned, or went into detail about, supports smart contracts. And you can acquire it through buying it at an exchange or an ATM or earning it. You can use it, you can invest it, you can play the markets, try to make some money. But most importantly, you don't need a lot of money right now to get into crypto. Like you can start with $5, $10, $50, whatever. You can do a recurring order to set up like a dollar cost averaging strategy to kind of even out your purchase price. So yeah, there's a ton of possibilities for crypto. It's a really exciting space to be in, and I hope that you have learned at least one thing today during this question. So we can take some questions.
Awesome. Thank you so much, guys. I learned a lot, so I'm sure the audience did too. Let's just pull up the questions in Q&A and go through them. The first one from Jerry, he's asking, Jamie said no one takes points from Bitcoin transactions, but Jake just said that the servers get a cut from doing validation. Yeah,
which is it. And that's a good question, Jerry. So I'll clarify what I mean there. When I send Bitcoin to Jake, nobody is sitting in the middle of that. But if I were to send the equivalent value of like US dollars, for example, to Jake, that would involve my bank. Let's say like Jake's in London and I'm in the US and we need to convert my US dollars to pounds. So that would go through my bank, which would connect to my online service, which would connect to, or they would talk to, Jake's account, move the money there into his account of the same online service. Then it would go to his bank. They need to take some foreign transaction fee there. They take a cut and then they give it to Jake. So that's like 3 parties in the middle, and I'm sure many other services. And then Jake, I'll let you take the part about servers getting a cut for validation.
Yeah, exactly. So it's not free basically, but it is like cheap. It's typically on the order of like, less than $1 if the network isn't like super congested at the time, but it can cost up to like a couple dollars to send a transaction through if there's like a lot of people trying to like use the Bitcoin network at once. So you can select the fee that you pay to a miner. And the reason you'd want to like maybe choose a higher one is if there is congestion, you could say like, hey, like please prioritize like this in the queue. And so miners will go in and like, they act in their best interest. They select the transactions in the queue that pay the highest fee. But typically, at this point in time, if you're going to use Gemini and send to like another wallet, Gemini covers up to 10 free withdrawals per month, which is pretty cool. So you won't have to worry about that miner fee.
Okay, I hope we answered your question, Jerry. I'm not really sure about Sean's question. Jamie, Jake, do you need him to rephrase it? So he's asking, how are they running the hash on a file?
Yeah, I mean, everyone runs like the, Bitcoin software. I have this slide from a different presentation, but I mean, I don't want to take the slides away from you, but essentially what they're doing is, you take what a sender is doing is they sign a transaction with their private key saying, hey, I want to send 1 Bitcoin from my address to another person. Like, let's say I want to send 1 Bitcoin to Jamie. I hash that message with my private key with saying I'm the sender and Jamie is the recipient. And then I send that up to the network with its hash. So like Bitcoin has like natively like a hashing mechanism in it. And then what the miners will do is, they'll take a bunch of transactions and they will run that through the same hashing mechanism and basically keep hashing it with, a new nonce, which is just like a random number. They'll just keep guessing random numbers and hashing that to see the output. And then when the output has like the required number of like, zeros at the beginning, since it's going to be a completely random like string of characters in like hexadecimal, it's pretty hard to get like, 7, 8, 9 zeros in a row. So they're just going to keep guessing that like hundreds of thousands, if not millions of times until they get one output with the proper number of leading zeros.
Thanks, Jake. Next question from Nathaniel. Is there any difference in the security of proof of stake versus proof of work?
Yes, I mean, at the end of the day, like it's so different, like and it's, bespoke per blockchain. So it's hard to say whether like at a high level, like proof of work or proof of stake is more secure. But maybe, we can go over a topic like that in the Crypto 201 seminar.
Got it. One question from Colin. I think it's to a point that you made. I think it was probably Jamie. While not necessarily our problem as the last coin is anticipated to be mined after our lifetime, what is the projected future of Bitcoin at that point? Is the value of the coin inherently tied to the fact that it takes so much effort to mine it, or do you think it'll become more of a novelty after a certain point?
Yeah, sure. I mean, really, this is all speculation. So these are like my personal opinions here, but I mean, the value of the coin is tied to the demand for that coin, and the fact that it takes so much effort to mine it and so difficult. I mean, one possibility is that Bitcoin is like the, paving the way for another technology or another type of crypto that is like more useful or more, I don't know, like just well adopted, whatever. So, I mean, the intended future is that Bitcoins will be continued to mine until they reach that 21 million. And then in theory, if we're like working off this pure market experiment, the value of those would continue to rise because like nowhere are getting created. So yeah, just pure speculation there, Colin. Do I think it'd become a novelty? I mean, like, maybe like are any other tradable assets a novelty? Is owning gold a novelty? Maybe. Kind of depends on how you define it.
Okay, I just want to be mindful of time because we are up on the hour. So for those who need to drop off, this session is going to be recorded and sent to you. So, you'll be able to see the answers to the questions. But for those who want to, you can stay on and we'll get through the questions. Another one from Colin. Speaking on private keys, is there an estimate of total lost coins to date? I know there have been instances of individuals who adopted early and never gave it a second thought and then lose their keys in excess.
Yeah, I think there have been a few articles saying that there's like up to 20% of like, private keys that have like gone missing, which is quite a lot. What was the second part of the question there? Yeah, I mean, it's unfortunate for people who lose their private keys. That's why using like, a professional custodian is important, or like, having backups to your keys if you keep it on like a ledger or on your phone or something. But yeah, there are tons of instances of people losing their private keys and coins that are just stagnant forever now.
Okay, and then I think for Sean, he had another question. Is the address on the block on the Bitcoin the hash for the block?
The address for Bitcoin is, like everyone has their own like public address, which is sort of just like kind of like your mailbox, I guess. You can, that's where you like receive Bitcoin. But that is part of like your key pair, right? There's like the private key, which is how you like send funds out, and the public key, which is where you receive funds into. But you're basically hashing a message and sending that to the network that miners will then pick up.
Awesome. Okay, last two questions. Colin is asking, for customers of yours trading platforms, are they being given keys generated by the platform for them to use, or are the platforms acting more as true brokers handling their own ledgers separate from the blockchain? In other words,
Oh, sorry.
No, go ahead.
Oh, I cut you off. I didn't mean to cut you off. So if you're using a trading platform like Gemini, no, you do not. You are not given, you don't have a private wallet address. You just create an account with your, email, some information about yourself, and then you create a password. So really what you need to access your funds is just your password. So the platform like Gemini, I would say not necessarily, I mean, we're a broker in the sense that we're like brokering, buying and selling, buying and selling between many different parties. But in this case, we act as the custodian for your assets. And so we have, we use this omnibus account model as well. Like it's the same as Venmo. This is what every, most financial institutions will use. So we have our addresses, and we keep one ledger for our customers. You do have the option though, that's just like if you're keeping your funds on exchange, you do have the option of holding your funds in custody, which is separate. And in that case, you do get your own address. You still only have to remember your password, so we make that easier for you. But holding your funds in custody means that they're held offline in a segregated wallet address for you. So a little bit of both, Colin.
Great. And then last question from Jim. Who pays the miners? Is it the entity that created the coin?
Yes. So basically the way that this works is like if you have Bitcoin yourself, like let's say you buy some on Gemini, then withdraw it out to like your own like ledger or, a wallet that you have on your phone or something like that. In the withdrawal that we are like Gemini is sending out to your wallet, Gemini is the one that's paying the fee since we are in custody of the funds at that point in time. And we, like I mentioned, we give 10 free withdrawals per month. However, if you are, once you have those funds in your own like private wallet and you want to send them back to Gemini or to pay a friend or whatever, then you are the one who like pays a transaction fee. And like I mentioned, like the higher your fee, the more likely it is to get mined sooner. But you can always like, if you're going to be managing your own fund like that, you'll probably be like looking at like what the current going rate is for a fee. And just to be clear, that fee that you're paying is distinct from the block reward, which is the one that halves every 4 years. That is just like minted essentially every block. That's like a fresh new like 6.25 Bitcoin that's given to the miner as a reward for validating the network.
Got it. Thank you so much, Jake. Okay, so we have come to the end of the session. Those were great questions, and thank you, Jamie and Jake, for the awesome presentation. I learned a lot, through that whole hour. I'm sure the audience did too. So for those who are listening in and still with us, I just want to remind you that we do have an upcoming webinar tomorrow by another participating company in the Digital Currency Innovation Lab. Liam Gris from CloudNalu will also be talking about investing in cryptocurrencies. So, if you are able to make it, please join us. I'll leave the link in the chat again for you to go visit, the site to sign up. Once again, thank you so much, Jamie and Jake. And I know it's late over on your side of the world, so I'm going to let you go. Thank you again today.
Thank you.
Thanks so much, everyone.